There we go. If you have a property that is worth $500,000, the rate, generally speaking, is after the first year at least is 4% for most buildings, which would give you a $20,000 write-off. The next year, your property would have a carrying value of $480,000. Again, you'd get a 4% write-off on that, which is $19,200. And so it would go from there. Okay, so. So we should be back to the slides now. So as I said, keeping records, it's a very necessary part of running a business, and understand that having a rental property, you're running a business. You need to keep them organized. And I would start with a system that organizes them by date, whether it's in a file system or a folder system, however you have it. The type of information you need to keep depends on what your business type is and some other factors. The format you use, whether it's paper or electronic or a combination. I used to run a computer consulting company for more than 10 years, and I don't trust computers not to crash. And when they crash, they usually crash at the worst possible time. So you need backups, both paper and electronic. Also, it depends on if you converted paper records to some sort of electronic version. There's rules around that as well. So for income records, you need to keep track of your gross income. For most of you, that's going to be rent. Some people were talking about short-term rentals, so that it's not quite rent, but it's, I guess you could say it's daily rent. So obviously you're going to record the date, the amount, and where it came from. Now, a lot of people don't realize that just because you don't pay cash or pay it with credit card, they think they don't have to record it. That's not true. You can have a barter transaction. It's still required to be recorded. So let's say that you have a larger rental property where you let the custodian stay on site in return for a reduced rent, right? So you're trading off rent for services. That's actually a type of barter transaction, and technically it's supposed to be valued and taxed as if you were getting that full rental income. But that said, you could also write off his services or her services. So original documents include things like sales invoices, receipts, or bills. And I should point out here that a lot of people think that if they're paying things with their debit card or credit card, that they only need to keep that statement. CRA explicitly says that's not good enough. They want to see the actual individual receipts or bills that you're paying with those cards. Now, that said, if you lose one or two and you've got 50 items on the statement, you're probably going to be okay. But if you have one or two and there's 50 items on the statement, then you're going to have some issues with CRA. Bank deposit slips, fee statements, contracts. So basically any paperwork with numbers on it, if you really want to shorthand the whole thing. So you always want to get receipts or vouchers, especially when you pay cash. There's nothing wrong with paying cash per se. It just leaves less of a trail, which is, of course, the reason why some people want to get paid in cash. But let's say you save 13% as an example. I don't want to pay HST, I'll pay cash. All right. Well, if it's a deductible expense, even if you're deducting things personally, you're deducting them at anywhere from, in Ontario at least, 20% to over 53% on your personal tax return, and over 50% if it's on a corporate tax return, which means you'd be giving up 50% plus in certain cases to save 13%. It doesn't make any sense. So get those receipts, even if you're paying cash. And the receipt needs to show the day of the purchase, the name and address of the seller or supplier, the name and address of the buyer, and the description of the goods or services, plus their HST number if they're an HST registrant. Now, this next point is very important down the road, and this is particularly on point for me now because I'm trying to keep a client out of corporate bankruptcy based on the fact that he didn't always do this. Don't claim HST unless your receipt shows you paid HST. So don't just assume you paid it. Make sure the receipt says you did. Then you won't have any issues. Now, of course, you don't always have those details on a receipt if it's a simple printout from a cash register as an example. So in that case, document it either on the receipt itself or in some sort of expense record you keep, whether it's in paper or electronic format. Now, they may not give you a receipt at all. As I said, you want to ask for one. If it's simply not possible, then create your own record. This is the worst case scenario when it comes to deal with CRA. And I should mention that because I deal with CRA on a weekly basis, it informs a lot of how I advise clients, which is to say, when they say, can I do this or that, I look at what would CRA think? And if CRA has no issue, then I'll say, yeah, go ahead. If they would have an issue, I said, yeah, you can do that, but if CRA ever looks at it, you're going to have a problem. And I don't like to have tax planning relate or be based on, gee, I hope CRA doesn't actually look at this. So to me, that's not tax planning, that's tax hoping, and I don't believe in it. Now, this is especially important when it comes to real estate. You need to keep track of the properties you bought and sold, as well as all the additional costs, such as those land transfer taxes, any renovations to your rental property. If you have a rental property for 5, 10, 15 years and you sell it, the chance of you remembering, oh yeah, I put a new roof on in the year 3 and I had to replace all the plumbing in year 5, you're not going to remember that realistically. So you need to write it down. You need to keep the receipts. And we're going to talk a little bit later about time frames for keeping things, but that sort of thing that drives the value or the cost basis of your property, you never get rid of those until you get rid of the building. And even then you should keep it for at least 3 years after that. Because that's the sort of documentation that's really hard to replicate years later. You know, everything's gone. So what's an acceptable record format? They say you can keep records that are in paper format that's later converted and stored in accessible and readable electronic format. That is much, much easier than it used to be. I worked for an international company called IT&T, and this was in the mid-90s. They were among the first I'd ever heard of doing that conversion, and it was $100,000 to start the project. Now you can buy a scanner for a couple $100 and you're off to the races. So, or you can keep it directly in electronic format. but it has to be accessible. So if you have paper, you keep it in paper format, unless of course you've imaged these documents. Records that are originally produced in electronic format have to be kept in electronic readable format, even if you have the paper. So it's not enough just to have the paper backups, although I certainly recommend that. As I said earlier, I don't trust them not to, the computers not to crash. So generally speaking, they want originals of the paper documents. You can, as we discussed, produce electronic copies, and they can be kept in any type of electronic filing system as long as you can still access it. It's important, however, when you're scanning these documents to make sure that it's an accurate reproduction, and the intent is for it to replace the paper document. It has to give the same information as the paper document. So, you can't have key bits of information cut off. And you have to be able to read it in terms of the resolution and the tonality and hue. So that's basically saying you can't have a dark color on part of the paper that obscures your ability to read the information. That's useless at that point for tax purposes. Now you can have reproductions instead of the originals. However, you have to follow certain standards. And there's some links here that you can just send me an email. I think that's probably the easiest, because I don't think they'll paste into the chat properly. But there's a couple of what are called information circulars. And, those items are available in exhaustive detail online. There's some more national standards that they have. Now, some people have commercial software that they do all this with. That's fine, provided it meets those same standards. Okay, now, many people, the reason they're scanning all this paperwork is so they can destroy the originals. So that's possible. Once you've got everything scanned and according to the standards, your images are now considered the permanent records. But if you have any doubt about whether you should or can, please consult a lawyer. But if you can't meet those standards we mentioned, you have to keep the original document. So I'm sure that's caught some taxpayers by surprise when they used an inferior scanning platform to do all this work and got rid of all the original documents. Now, these standards can be viewed on the web or purchased on the web, or they're also available for viewing at certain libraries, if they're even open these days. I'm not sure. So it's important to back up electronic files regardless of what medium they're recorded in. As I mentioned, I'm CFO for a home builder, and part of my responsibilities there is I also look after all the technology based on my earlier background. And it's not enough just to set things up. You have to monitor and test your backups, because I found, much to my surprise, about 2 weeks ago, that the backups weren't actually they were running, they just weren't running successfully. So you have to monitor the backups to make sure they're actually running successfully. But then you have to test the backup, because there unfortunately too many horror stories about people who had some sort of disaster at the office, had to recover their information from backups, were very confident because they had been running some sort of backup for years. Only problem was they never tested it. And they found out the hard way that all these backups that they ran never actually worked. So don't do that. Whatever backup system you're using, make sure you do test it. Of course, unlike paper, these media are much more sensitive to things like extreme temperatures, to magnetic fields, direct light, or even just too much moisture. So that would come out if you're testing your backups. You find out you can't store them where they're stored because they're deteriorating in quality. So if you're keeping things in different mediums, just follow the suggested instructions of the manufacturer and pay attention to the shelf life. As I said, backups aren't forever. People have pulled out diskettes that they actually were properly backed up to, only to find that after a few years, they couldn't actually be read. That leads me to the next point, was ensure that whatever backup system you've used in the past is kept in a format that is usable and accessible. So you need to keep at least one piece of equipment on hand that can do so when you upgrade, because you may upgrade to the latest and greatest computer to find that the software that runs your backup is no longer being produced, which means you can't actually get a version that will run on the new computer. And now all your backups, even though they were properly done, properly tested, properly maintained, they're not accessible. And you will not get very far if you tell CRA, hey, trust me, all the information's there, we just can't read it. That's not going to work. If you pay someone else to keep your records, they still must be made available to CRA when they're requested. And again, there's some more information about the electronic backups. So where to keep them? Generally speaking, it's one of two places. It's going to be in your place of business or your personal residence. If they're not there, and that's actually a question on the corporate tax return. Yeah, I don't think it's mentioned the personal, but it's definitely on the corporate tax return. Where's the books and records? Where are they kept? So records kept outside of Canada and accessed electronically from Canada are actually not considered to be records kept in Canada. So if you're using some sort of server farm to keep everything gets backed up to the cloud, and that cloud isn't located in Canada, you're going to have a problem. You have to, in that case, make sure that you make any arrangements that are required. But I would just make sure it's in Canada. There's enough services that offer cloud storage. You can find one that's in Canada. Now, how long? This is important. Generally, you have to keep all the required records and supporting documents for at least 6 years from the end of the year they relate to. So the tax year for corporations is the fiscal period, whatever that's been set to. Maybe it's December 31st, but maybe it's March 31st. I have a client that has an August 31st corporate year end. It's whatever that is. So 6 years from that date. For individuals, it's calendar year. So December 31st plus 6 years, that's the general period that you have to hold these records. And please keep them organized. A little bit more time when you put these records away will save you hours, if not days, whenever you have to pull something out down the road. The rules for the retention of records are pretty much the same under the Income Tax Act, the Excise Tax Act, which is what covers GST or HST, the Employment Insurance Act, and the Canada Pension Plan. So they're all very similar wording 6 years after the year end that they apply to. As we discussed a little bit earlier, in some situations, you must retain your records for a different period of time. So some of those situations are when it's concerning the long-term acquisitions and disposal of property, like we talked about, the real estate. So anything to do with shares, historical information that would affect the sale or liquidation of your wind up of your business. You want to keep those indefinitely. CRA has been known to go back decades to find out how businesses were dealt with certain things like shares, and maybe they had a building they bought decades ago. You need to keep that. If they want you to keep them longer, they will tell you. But as a minimum, 6 years, if it's not one of those longer term issues. Now, if you file your income tax return late, then the 6-year clock doesn't start ticking until the date you actually file. And similarly with an HST return, if you haven't filed that on time, the 6-year clock doesn't start until you filed. Sometimes you file an objection or an appeal. So you want to keep records related to that to the latest, so of the following dates. So the date the objection or appeal is resolved, the date for any further appeal has passed. So you typically have 30 days or 90 days to file a second appeal. You have to wait until that has passed. And the 6 year. So whatever is the latest of those 3 dates. If you're unincorporated or another type of organization and you shut down, you must keep your records for 6 years from the end of the tax year in which you ceased operations. When a corporation is dissolved, it has to keep the records for 2 years after the date of its dissolution. So anything required to verify tax obligations and entitlements and what other records. So it's 2 years past the date because they're incorporated. So the rules are a little bit different. If corporations amalgamate, which means they come together or merge to create a new corporation, usually you have to keep the records for 6 years from the end of the year to which they relate. So again, it's a 6-year rule. If you destroy paper or electronic records deliberately, of course, without CRA's permission, they reserve the right to prosecute you. Now that's rare. It would only likely be done in the case of where there's some sort of review or audit and you destroyed them deliberately without permission, then they might get a little cranky at that point. Now, this only applies to records that you have to keep under legislation that CRA administers. They cannot approve destruction of any other records that you have to keep under other federal or provincial, territorial, municipal laws or programs. They all have their own rules around that sort of thing. CRA reserves the right to review your business systems. This is a rare event, but it's possible. And that would be in the case of where they find your records are just very, very poor. They may want to come in and have a look at what you're actually doing to keep them. And the goal they would have is to make sure that whatever systems you have, it meets the CRA record keeping requirements. And again, as I said, it's a rare thing, but they'll just want to get an overview of how you're doing things. And you have to provide this information. A lot of questions come up around, do I have to respond to CRA's requests? Unfortunately, they have very wide-ranging powers and abilities. So you always want to check with your accountant or lawyer when they're asking these things, but you often have to do that. And then you just have to keep what's called an audit trail. That's basically just showing as the paperwork comes in, how it gets put into your accounting system or record keeping system. That's just a fancy term for showing the path of the numbers from the paperwork into the electronic records. That's all. Just quickly go through that. So key takeaways. Make sure you claim all the expenses you're entitled to legally reduce your income taxes, especially the big three of interest, property taxes, and repairs and maintenance. I remember I had a new client, had a rental property. I said, I need to see your last year's return. And there's property taxes, yes. Repairs and maintenance, yes. No interest charge. I said, oh, that's kind of strange. Do you have a mortgage on this property? Yes. Then why is there no interest deduction? Well, unfortunately, she went to one of these income tax services where they get minimal training. They didn't ask her, she didn't volunteer it, and she gave up the single biggest deduction she had on her tax return. It's unfortunate, but it can happen. Certain expenses that are typically written off over time can be written off immediately for fix and flip situations. Don't claim HST if you haven't paid HST. Now, I should say that if you only own residential rental properties, this is not an issue for you because CRA will not let you register for HST. And even if they do, eventually they'll come back and cancel your registration. Whatever HST you claimed over whatever it was, a year, 2 years, 3 years, you'll have to pay it all back. So this only applies if it's a fix and flip, if it's a short-term rental, if it's a commercial real estate situation. And if you're working from the original invoices and bills, it's going to be very easy to get the amount of HST. It's when people are working just from bank statements and credit card statements, and they're just estimating based on the final number how much is HST, that's when you can run into trouble. So you're obviously going to keep all your receipts, bank and credit card expense listings, keep things basically for 6 years after the year they applied to, or the return is filed, whichever is later. And certain records you'll want to keep indefinitely, like we talked about, something relating to the property purchase. Electronic images are as good as the original documents, as long as they are complete and fully legible. Consult a lawyer before destroying records if you're not sure if you can. So our next event, it's going to be October 28th, so 4 weeks from now. Again, 7 p.m. start. And topics and other details will follow in about 2 weeks from now. So now it's open questions. Just unmute yourself and ask.
With regard to the fix and flip business rather than the long-term rental,
Right.
The difference between the cost of the property that you purchased plus its renovations plus any other like legal expenses that you mentioned in your presentation, is that difference between that and the sale price, is that considered a capital gain or is that considered a business income?
That's a great question. It's considered regular business income. A fix and flip is entirely taxable. So if you have a rental business Long-term rental, you hold a building for 3, 4, 5 years. Excuse me. You then sell it. Any gain beyond the price of what you paid will be considered a capital gain. Therefore, half of it will be taxable. If, however, it's a fix and flip, whether it takes you 3 months, 6 months, 9 months, God forbid, 12 months to do all the renos and then sell it, 100% of that gain will be taxable. There's no offset. There's no capital gain portion in that case. So there's a trade-off where you get to write off everything right away. The trade-off is all your gain is taxable. It is, however, taxable at what could be a lower rate depending on your other sources of income and depending on whether you're incorporated. But certainly if it's a corporation to corporation, flipping corporation to rental corporation, you're talking in Ontario 12.2% tax on the first $500,000 of net income. So after you've taken off all your expenses, in the case of the fix and flip, and 50% if it's a long-term rental business. And if you're going to fix and flip, you must incorporate. There's just too much legal liability. As I said, I work for a home builder, and there's what's called a conciliation process when the home builder says, oh, you got to fix all this stuff. And we say, no, we don't. And it's adjudicated by a governmental body. And the guy actually had the nerve to say that the electrical panel, which he broke, is our responsibility to fix. Now, because he actually admitted he broke it, the arbitrator says, well, as soon as you touch it, the home builder has no responsibility to fix it. But even though he broke it, he was still willing to blame us. So definitely incorporate if you're going to fix and flip.
Thanks.
Okay.
So Michael, to expand on that that question around fixing and flipping and the taxes, if it's an extensive renovation, and I've been reading about, you know, if it's greater than 90%, there's certain ways to calculate whether it's considered extensive renovation or not. It could trigger an HST tax, if I'm
That's right. That's right. Yeah.
And so what are some of the ways, if you're doing a fix and flip and it would be considered, you know, an additional HST tax that you need to pay, is the HST tax payable on the delta between, you know, the selling cost the income from selling it, and the delta between your total cost, which is purchase, renovation, carrying? Is it on the delta, or is it basically from purchase price to sell price?
No, it would apply to the entire sale price.
It implies, okay, to the entire sale price.
Now, we only have a couple of minutes, but in the case of a rip it down to the studs, which is basically what you'd have to do to even come close to 90%. If you're doing a typical $20,000, you know, paint, carpet, couple of appliances on an existing property, HST is not going to be an issue because you're going to be nowhere near 90% renovations. But if you are going to a big renovation like that, you're not paying HST on the way in because it's a used home, right? You're buying a used home.
Right.
You're going to pay HST on all the supplies that you consume. If you hire contractors, presumably they're going to charge you HST. All that you'll have available to offset what you charge the buyer of the new home. The way the contracts are always written is it'll say if HST applies, it's included in the price, right? And then the lawyers fight it out whether HST applies. But the reality is whatever you sell it for, that either includes HST, where HST applies, or it doesn't include HST because HST does not apply. Under no circumstances are you going to be allowed to go back to your buyer and say, oops, forgot to charge HST. you owe me another 45, 50,000 on top of what you paid. It will never happen.
Mhm. Thank you. Yeah, it seems hard to see how you make money doing renovations with extensive flips and HST because it's not a wash in terms of the HST that you paid to your
No,
contractors versus the, yeah.
Yeah, I think you're right. The truth is, though, people that are buying such a heavily renovated home, probably a couple, 20,000, 30,000, 40,000 extra of cost based on HST is not going to scare them off, right? Because they're paying millions for a home like that if it's anywhere in the Toronto area.
Right.
So,
Thank you.
Yeah. All right. If there's no more questions, we have just a minute or two left, but if you would like to schedule a session, you can copy down my email. Let me just put it in the chat.
Michael, if I could also,
Yes.
in the future, perhaps for one of the future events, would you consider speaking more towards passive investments in the real estate, such as private lending, that sort of thing?
Yeah, we can cover any number of topics in that area. Happy to take suggestions from
Great.
everybody that's in the group, and we're only doing one a month, so we're not going to get to everything right away, but absolutely, if it's a topic of interest, more than happy. I want you guys to get something out of it. And if there's a particular topic, especially if a couple people ask, I'm more than happy to scrap what I had in mind and go with that for the next one. So I guess you got 2 weeks to get you can contact me either through the meetup group or through the email that I just put in the chat.
Terrific, thanks.
Okay, so I think that's about it. Thank you for coming. Appreciate your attendance. I appreciate your questions. And by all means, as I just said, if you have a suggestion, feel free to pass it along and we'll go from there.
Thank you.
All right, thanks everybody. Have a good night.
Night.
Bye now.